Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Those numbers would be flashing on the screens very soon. Net profit at 1,975 crore rupees. So we just have one figure right now, 1,975 crore rupees versus the poll of 2,276
On the
crore
top line,
rupees.
we have revenue growth, which is coming at 2,246 crores, roughly thereabout. 2,246 is on the top line, 22,459 crore, beg your pardon, and that is pretty much in line with what the street was expecting. Trying to calculate the margins, but seems like the net profit, which is below the estimates, and the revenue is in line, would imply that the margins are perhaps a little lower than what the street was working with. We were working with margins of close to 3391 crores, but seems like the revenue has been in line with expectations, just about 100 crore higher than there. EBITDA at 3351 crores also seems like it's pretty much in line with expectations. So let's try and look at if there is something which is below. Okay, tax expenditure has increased a little bit, so that is something we'll have to watch out for. Current tax is coming at 8355. That compares to 5578. So that is something which is impacting the net profit, but seems like the top line and the margins are in line so far. Sonia is joining us. Sonia, what do you make of these numbers so far?
Well, yeah, they look okay. The top line is absolutely in line with estimates. The sales volumes have gone up by 24.3%. I'm just reading out from the press release, the net sales have gone up by 27.3%. So absolutely in line with estimates. The EBIT number also has come in at 3351, which is also largely in line. It's a 45% jump that we're seeing in the EBIT. The profits, I'm not sure why the profits have been lower than estimates, but it's just a 27% growth that we're seeing in profits versus an expectation of about a 46% growth. The material cost for the company, I'm just reading out from the release itself, has come in at 71%. Now, on a year-on-year basis, it's a fall that we're seeing of 60 basis points. But on a quarter-on-quarter basis, material cost has gone up. So 71% is raw material cost as a percentage of sales compared to 67.9% last quarter and 69% in the quarter before. So quarter-on-quarter, yes, there's an up move that we're seeing as far as raw material cost is concerned. Otherwise, doesn't look like there is any reason why the the profits should be sort of below expectations. There's some commentary from the management as well. They say that they have undertaken cost reduction efforts. Lower advertising expenses is what has aided them in the EBITDA performance this time around.
Right.
And the economies of scale partially offset by the adverse commodity prices.
Looks like the profit has been below estimates on account of other income, because the other income has come in at 271 crores. That compares with 682 crores. So there's been a 400 crore reduction in other income, and that other income has actually come in lower even quarter on quarter. In the March quarter, we had 595 crores of other income, and that compares with 271.8 crores that the company has posted in terms of other income. So that is perhaps what explains the lower profits that the company has posted, and lower as against our polls. But as far as the revenue is concerned and margins, looks like it's in line.
It looks like it's in line. 14.9% margins is slightly lower than the 15.1% that we had estimated, and that is because of this reason. Raw material costs as a percentage of sales has gone up to 71%. Also, the management in their commentary says that not only rising commodity prices, higher fuel prices are a worry going forward, and the adverse foreign exchange is also a worry for the company going forward. But they do say that this will be offset by a strong product portfolio going ahead. So the top line projection is quite strong, but they say that higher fuel prices and rising commodity prices is something that could continue to be a drag on the margins going ahead. So yes, operational performance has been hit slightly. I'm just going to try and calculate the realizations as well, Mangalam.
All right.
But for now, if you compare...
the other income, the management has given an explanation as far as the other income is concerned. The reason why the non-operating income is lower is because of mark-to-market impact on the invested surplus compared to last quarter. So that explains the lower other income that we're seeing, which is coming closer to that 272 crores. That compares with 600 crores or thereabouts is what we have said. And meanwhile, we have Prakash Diwan with us as well. Prakash, what would you make of these numbers from the revenue and EBIT perspective? And the net profit is lower on account of other income. How much salience would you give to that?
Not much. Even last quarter, you had this one-off expense which took away some, wind from the sales in terms of the income, other income side. And this keeps on happening to Maruti because you remember they also have a decent sized treasury which contributes to that. But as long as the EBIT is not getting into stress, as long as the margins on the EBIT level are not stressed, I don't see any issue. And Maruti, the easiest part is to forecast or to anticipate the top line growth, which has been much better than what people had anticipated. It's always the product mix and the average realization. So if that tends to go higher, and which could possibly be a worry area if it doesn't go up, I don't see any concern with these numbers. The market might reduce EPS expectations, and that's why you see a little bit of a negative reaction, that 2-3% that's coming off. So it's run up in anticipation of very highly profitable numbers. So the numbers are not profitable, but they're not bad either.
Okay, so the numbers are not bad. Of course, if you compare the margins at 14.9%, this compares to 14.2% last quarter and 15.6% in the quarter before, 16.9% in Q2 of FY18. So the margins have actually fallen from an average of around 15 to 17% now to about 14.5% for the last 2 quarters. Prakash, there are raw material cost pressures, higher fuel costs that the management talks about in their press release. You know, the stock is not cheap right now. I mean, if you look at it versus its 5-year historic average, it's trading much higher. It's now at 25 times FY20. You think some of these deterrents like higher raw material costs, higher fuel costs, etc., could put a lid on the upside in the near term?
Oh, absolutely. So, the run-up itself was pretty, over enthusiastic because, as I remember you mentioning it in one of the, pieces earlier today, that this flight to safety from 2-wheelers to 4-wheelers is probably one of the reasons why Maruti is found favor. And this is a common trend across auto OEMs. So Maruti cannot remain away from that, where, there is pressure in terms of them topping out on the stock. The business could continue doing well, but the stock has already been ahead of the improvement in sales numbers and revenue growth. So that's where, some sort of a takeoff would happen. People will take some profits.
All right, hang in there, Prakash. In the meanwhile, we're also getting Colgate's numbers, and they do not look good. I'm looking at just 2 numbers, and that should tell you the story. Volume growth has been lower, and this has come on the back of a lower base. In the base quarter, the volumes declined by 5%. We were working with a growth of 5 to 7%. The volumes have grown at 4%. And second, and the bigger worry for Colgate is the loss of market share. Remember, the previous quarter, the market share was closer to a historic low, perhaps at least 20-21 quarters low. And now from there also, it has fallen below that 53% mark and has gone to 52.4%. This at a time where there is some ease off in the competitive space. So it means that there are other players than Patanjali who are eating into their market share. The revenue pretty much in line with what the poll was, just 20 crores below that. The key disappointment for Colgate, of course, is the fact that they're continuously losing market share. This time it's come below that 53% mark. 52.4% is what the company has
management commentary, Mangalam, is also stating that Colgate continued its volume growth momentum despite a high level of competitive intensity, and the company registered volume growth of 4%.
That is still below what the street was expecting, 5 to 7%. So if 4% is what the company is doing after focusing on volume growth momentum and still losing market share, remember they just 10-15 days ago, they had also reduced the price of Swarn Ved Shakti by about 10%. Add to that, they had increased the distribution penetration of their naturals product as well. Despite that, despite all the efforts that the company is taking, if the market share is coming off, that is something we will definitely have to watch out for. But let's just focus back to Maruti. Sonia, any other details that you're gathering?
Yes, in fact, I've just calculated the realizations, and there is a very minor dip in the realizations this time around. 4.5 lakh rupees a unit is what they've clocked in terms of realizations versus 4.58 lakh rupees per unit last quarter. So actually realizations are pretty stable. It is only the lower non-operating income because of that mark-to-market impact on that invested surplus, which is the reason why the profits are below street estimates. Otherwise, it's a tad bit of a disappointment on the margins, 14.9% versus 15.1%. But I think the fact that the stock has seen such a big run-up is the reason why you're seeing a bit of profit taking over there. Nitesh Sharma is also with us. Nitesh, these look like a decent set of numbers. The top line growth of about 27%. The EBITDA, has also delivered this time margins at 14.9. What would your own view be on how to approach the stock post earnings? Nitesh, is my voice reaching you?
Yeah, hello. it was a marginal miss compared to what we were expecting as well as street estimates. On the EBITDA front, just a 2% miss on EBITDA, mainly because of strengthening in raw material prices, a trend which we saw across all the OEMs who have reported in this quarter. I think the company would be taking price hikes in this quarter to mitigate the RM pressures that they have been seeing. Even in the previous con call, Maruti had highlighted that in the run-up to festive season, they would take some price hikes to mitigate the raw material cost pressures. So overall, I think we would be content with these numbers. We think there is some scope of further re-rating in the name because investors are wary of the two-wheeler space post the aggressive commentary from Bajaj, plus also the new axle load norms in the MHCV segment has made investors wary of the MHCV segment. So to play the automotive space, investors would be looking at names like Maruti and Mahindra. These two are the names which are more immune to the regulatory as well as competitive pressures. So there could be some further re-rating in the name. That's what we are expecting.
That actually is one of the reasons, why the stock perhaps has done so well lately. There's a flight to safety premium that Maruti is enjoying because a lot of investors have moved out of two-wheelers and out of commercial vehicles because of the uncertainties there. We also have Chirag Jain of SBI Caps. Chirag, the two problems this time, raw material cost as a percentage of sales has gone up to about 71%. But of course, the management has indicated that they will sort of pass this on. Fuel prices are also a concern. According to them, in the presentation, they mentioned that going ahead, fuel costs moving higher could keep a lid on their operating performance. Your own views on how to approach the stock, and would you change your EPS estimates for FY20? What does it stand at now, and any changes post-earnings?
So as far as results were concerned, broadly in line. Obviously, other income tends to be a bit lumpy across quarters. So, I mean, obviously, we would require more clarity from the management. But by and large, don't see major change in numbers. Obviously, we need to watch out their volume growth guidance because obviously we all know that demand has been fairly strong for Maruti and their growth is largely constrained by capacity. So how fast they are ramping up their production, that's something needs to be watched out. Commodity cost is something that they have clearly highlighted. That's a pressure point. But again, as demand is fairly strong and competitive environment remains reasonably weak, there could be pricing flexibility which the company may exercise. So I think by and large numbers have been fairly in line other than the treasury income. So more on the management commentary, especially on the price hikes, this is something that needs to be washed out apart from the production ramp up that they can achieve.
Okay. Chirag, thanks a lot for joining us and thanks to the others as well. So just to summarize it, it's a marginal miss in the margin performance. That's because of higher raw material costs. Otherwise, the numbers look okay. Of course, that lower non-operating income is the reason why the profits were impacted.
All right, Sonia, thanks a lot for that. That's as far as Maruti is concerned. And Colgate, of course, is at the low point of the day. Market share loss